The year's 1998. The dot-com bubble's in full swing, and investors are pouring money into anything with .com in its name. It doesn't matter what the company does, how much it's made, or even if it has a business plan. It's an internet company, and internet is the next big thing. While internet stocks are flying high and people are making a killing, Warren Buffett is not having a good time. Berkshire Hathaway stock has dropped to its lowest in years, and has a massive $15 billion cash position with nowhere to invest. Articles are talking about how Buffett has lost his way and why he should choose a successor. Even investors are starting to get skeptical and dump Berkshire Hathaway shares. Fast forward a few years, and it's the year 2002. Almost all the internet companies have collapsed, and NASDAQ, the internet companies index, is down 70%. Berkshire Hathaway? Its profit has almost doubled, and the share price has reached $74,000 from a low of $42,000 in '98. Warren Buffett is not new to getting criticized when the market's flying high. Making money seems easy and no one understands why Buffett isn't buying, but he always comes out on top when the market crashes and everyone else loses money. To give you an idea of how insane Buffett's performance has been, here's a quick comparison. If you had invested just $100 every month in Berkshire Hathaway's stock since its start, you'd have a mind-boggling $120 million today. If you'd invested the same in the S&P 500, you'd end up with about $1 million. So what's his secret? How does he always manage to beat the market? Stay tuned in the video to find out. This is the story of Warren Buffett and how he became the greatest investor of all time. Warren Buffett was born in Omaha, Nebraska on August 30th, 1930. He would show great entrepreneurial instincts early in his life. When he was 7, he wanted to sell soda, so he collected 8,000 soda cans from different gas stations to decide which soda was popular. He concluded Coke was overwhelmingly popular and started selling it. By the time he was 11, he'd saved up $120, equivalent to $2,500 today. He was now ready to enter the stock market, and he bought his first shares in a company called City Service and bought 3 shares for $38 each. I know what you're thinking, but no, it didn't skyrocket. It fell immediately after he bought it, and Buffett thought he lost all his savings. He was lucky though, so he waited and cashed out with a $5 profit. However, after he sold the stock, it immediately shot up to $202 per share. Buffett later said he learned a valuable lesson from this price. Do not rush to grab small profits. This is when he realized there was a lot of money to be made in the stock market. It took him 5 years to save that $120, but he could save $500 if he had just waited. After this, Buffett started a lot of businesses like setting up paintball machines and barbershops and delivering newspapers. He had even bought an acre of farmland by the time he was 15. When he graduated high school, he was worth a cool $9,000, which is around $100,000 in today's terms. Warren Buffett had tried to understand the stock market a few times at this point. He'd read almost every book he could find, but wasn't having much success. Believe it or not, even Buffett tried to do technical analysis at first. Everything was about to change though. In 1949, 2 legendary value investors, Benjamin Graham and David Dodd, published their masterpiece, called The Intelligent Investor. This book is considered the greatest book on investing, and it was about to define an entire generation of investment philosophy with Warren Buffett as its biggest successor. But for now, it was just another book on the stock market. He saw the book in a local library and picked it up without thinking much. When he read the book, it was a eureka moment for him. He had been doing everything wrong. The book had a clear message. Stocks represent ownership in an underlying business. When you're buying stocks, you're buying a part of that business. So don't look at what the stock is doing. Instead, look at what the business is doing. Its real or intrinsic value depends on how much the business is making and how much it's capable of making. The book insisted that if a stock is trading significantly below its intrinsic value, you should buy it. Graham called them undervalued stocks. If the business is doing great, stock prices don't matter. Sooner or later, the market will reflect a business's true value. Before this, Buffett had never thought about it in such a way. He was looking at stocks as ticker symbols and trying to predict what would happen next. Now he knew he wanted to be like Graham and Dodd. Warren Buffett had always been an avid reader, and now he was about to devour financial statements and annual reports of companies. He read through thousands of pages of companies' financials and built a solid understanding of businesses. However, there was a problem. Everyone was looking at these big companies, so there was just too much competition. So he had to find companies that were too small for big investors. This part's important for later. Now he started reading something he called the Pink Sheet, which had information about the financials of companies too small to be traded on a stock exchange. There was so little competition, and undervalued stocks could be found easily. This is when Buffett would get a great opportunity to study under his idol, Benjamin Graham. He was a professor at Columbia University and taught investing. David Dodd, the co-author of The Intelligent Investor, took the first few classes and was impressed by Buffett. He said Buffett knew the book even better than Graham and himself. He would soon start working under Graham in his partnership firm called Graham Newman Fund. This is when Buffett learned about an approach called the cigar butt. The idea was to find bad companies that were trading at such high discounts it was virtually impossible not to make money. Like one last puff left in a cigar butt. Graham usually preferred stocks that were trading at a price significantly lower than their book value. Basically, book value means the net assets a company owns. This is where Buffett would get one of his biggest wins. Buffett bought an insurance company called Geico after a 4-hour meeting with the assistant of the company's president. He made a 50% return in a few months and sold it later. By the time the 1960s came around, Buffett had left Graham's fund and was running his own fund. He was already big. He had beaten the market by 177% in just 5 years. However, this is where he started to notice the flaw in his approach. Warren Buffett made such ridiculous returns by looking into stocks that were too small for big investors. He would look through thousands of pages to find one small company that was very undervalued and buy it. For instance, one of Buffett's first investments in such companies was Sanborn Maps. The company had a share price of $45, but it had $65 worth of blue-chip stocks just in its balance sheets. He would either liquidate the company and sell its parts, or change the management to make it more valuable. But by the 1960s, he was growing too big for this. This is also when he met Charlie Munger, who is now the vice chairman of Berkshire Hathaway. Munger thought very differently from Buffett. While Buffett was focused on buying bad companies at a really cheap price, Munger argued they could make more money by buying great companies at a reasonable price. After a while, Buffett was convinced by Munger to buy great companies, and the rest is history. Warren Buffett has invested in companies like Geico, Coca-Cola, Apple, and a lot more, which have stood the test of time. Geico's grown 1,000 times, and Coca-Cola is stronger than ever. Buffett learned the essence of value investing from Graham, but added his own twist to it. While Graham believed in diversification, Buffett goes all in on companies he loved. In fact, at the end of 2022, 40% of Berkshire Hathaway's portfolio is in Apple. While Graham focused on buying very cheap companies and selling them for a profit, Buffett buys great companies for a fair price and holds them forever. But the idea is still the same. Buy companies that are trading below their intrinsic value. Warren Buffett has completely changed the investing landscape and defined a generation of investing. He took Graham's work and took it to a whole new level. Today, Berkshire Hathaway is a $500 billion company with stakes in thousands of companies. Just like the dot-com bubble, Berkshire Hathaway's cash position has reached $120 billion. People are talking about how value investing is dead and how Buffett's lost his touch. But it looks like Buffett might prove everyone wrong again. Berkshire Hathaway stock is up 5% this year, while the overall market is down 20%. Tech stocks are down even more, and Buffett is starting to buy. Whatever you think of him, you can't argue he's the greatest investor of all time, and he's an inspiration to every aspiring investor. If you liked the video, don't forget to give that like button a gentle tap. I'll see you in the next video.